What are the main types of taxes? Have you ever wondered what the difference is between income tax and wealth tax? Or why some people pay taxes on inheritance and others do not? Most governments collect revenue through a mix of taxes, but not all are the same. Wealth taxes apply to everything a person owns: cash, real estate, investments, even valuable art, minus debts. They are calculated yearly and are called net wealth taxes. Few countries have them, but the idea is gaining traction, especially in cases concerned with wealth inequality. Inheritance taxes apply when someone dies and leaves money or property. Some countries tax the estate before it is passed down. Others tax the person receiving it. Property taxes are ongoing payments based on the value of real estate. Separate from this is property income tax, which applies to rent or income from the property. Income tax applies to salary, dividends, pensions, or business profits. In many places, it is progressive, meaning the more you earn, the higher the rate. Capital gains tax applies when you sell an asset. Only the gain is taxed. Corporate tax is paid by businesses on profits after expenses are deducted. Illicit financial flows such as money hidden in offshore accounts bypass the tax system entirely. These flows drain billions from public budgets each year. Stopping them requires international cooperation, tougher laws, and transparency. Each tax plays a different role in how fair or unfair a tax system is. Tax rates across Africa. Tax rates in Africa vary widely. South Africa's top personal income tax rate is 45%. Libya's is just 13%. Wealth tax is rare. Only Zimbabwe has a law for it, targeting the super rich. South Africa has discussed a rate of up to 9%, but it has not been introduced. Nigeria and Uganda are working to improve collection. Capital gains tax in Kenya is 5%. In Uganda, it can reach 30%. South Africa's rate averages 18%, depending on income. Tax rates differ greatly, and not everyone pays equally because of how taxes are applied, collected, and enforced. Who's paying what, and is it fair? When it comes to taxes, fairness is about more than numbers. Supporters of progressive taxation, including the International Monetary Fund and the World Inequality Lab, say wealth taxes, high income brackets, and strong capital gains taxes can fund education, healthcare, and fight inequality. Critics argue that high taxes can scare off investors and cause capital flight, but this risk is often overstated. In the United States, there is no formal wealth tax. The country relies on capital gains and estate taxes. Yet, the top 1% still own over 1/3 of all wealth. The system is progressive on paper, but loopholes, low capital gains rates, and offshore shelters weaken its impact. Globally, evidence shows that well-designed progressive taxes can reduce inequality while still supporting economic growth. What can the world teach us about taxing the rich? Some of the richest and happiest countries are also the most heavily taxed. Denmark's top personal income tax rate is 56%, yet citizens enjoy universal healthcare, free university education, and low inequality. Public trust remains high because people see where their money goes. Sweden built prosperity on high taxes but cut capital taxes to compete globally. Investment grew, but inequality increased. South Korea used progressive tax revenue for social spending and long-term investments in technology and infrastructure. This helped cushion economic shocks and build resilience. Some Eastern European countries tried flat taxes. This simplified tax codes but did little to reduce inequality. Many are now rethinking the approach. Progressive taxes work when they are transparent, targeted, and part of a broader social contract. It is not about how high taxes are. It is about how well they are used and whether the system feels fair. Taxes show us part of the story. but inequality runs deeper. In part 5, we'll uncover its roots and ask, what can we do about it? Subscribe so you don't miss it.